Hello, my name is Stephen Beal, and we're continuing with part 3 of how to buy a business regardless of the economy. In this segment, we want to focus on valuation. As I mentioned, my name is Stephen Beal, and I'm the principal and owner of Beal Business Brokers and Advisors, and we help people buy, sell, value, and improve their business. Now, business valuation is tricky. It's not like residential real estate where you can take a look at a couple of houses in your neighborhood and what they've sold for and make a direct comparison and say, gee, my neighbor's house sold for $500,000 and my house is slightly bigger or smaller, therefore I think my house should sell for 510. So we don't have simple examples like that or simple comparisons. What we do have are databases that are North American wide. So we can say, okay, what does a bakery typically sell for anywhere in North America? But can we really compare a bakery in Winnipeg with a bakery in Toronto versus Vancouver versus New York versus Los Angeles? It's not necessarily straightforward that the metrics that we can use in a larger city apply to a smaller city or vice versa. What we do with valuations, we look at 3 broad methods. And in every valuation, we're going to look at all 3 of these aspects. So the first one is a straightforward one, just what are the assets that they have? What are the liabilities? So this is basically balance sheet driven. So as we look at each of the assets, we determine, does the balance sheet accurately reflect the value of that asset? So things like real estate, we might sort of write up because you bought the real estate 20 years ago, therefore the balance sheet is a poor reflection of the real value of that asset. Other assets we might need to write down. You might have bought, you might have a lot of investment in computers, and computers can depreciate faster in the real world than they do on accounting records. And there may be other assets that need to be written up or written down. Liabilities, typically there's less of an issue on the liability side, but we make all those adjustments and say, okay, this is what the balance sheet is telling us the business is worth. The second most common method, or perhaps the first most common method, is the income statement approach, where we focus on the cash flow or the earnings of the business. And this is where we say, okay, how much money does the business make, and what does that tell us about the value? The third method there is referred to as a market-based, and this may not look at either assets or cash flow or earnings, and primarily at what do similar businesses sell for in this market. And this, the best example of this type of approach would be how are stocks valued or traded at least. So you look at, if you want to value any of the banks in Canada, you look at price earnings multiple of all the other banks and say, okay, this is what the market is telling us that bank is worth today. So a market-based measure tells us what certain businesses sell for based on what this business is worth based on what similar businesses sell for. Just want to make a caution that all 3 of these are useful. As I mentioned, we look at all 3 of them in every valuation we do, but they're not additive. So if the income statement tells us that this business is worth $5 million, we don't then go and add all the assets. They might have $3 million worth of assets on the balance sheet. So the total number isn't 8. It's 5 million, and the balance sheet, the $3 million balance sheet, is required to earn enough income to give a value, a business value of 5 million. So if we focus primarily on the income approach, which is the one used 90% of the time in valuing a profitable business that as a business buyer you'd be interested in buying, there's 2 key things that you need to take a look at. Basically, there's the earnings of the income, and then there's the factor. So how much, if this business earns $1 million a year, what multiple are we going to attach to that? So a business that generates $1 million a year could be worth anywhere from $5 to $7 million, depending on a number of different issues that we'll touch upon as we go through this webinar. So let's start with definition of income. So first of all, I mentioned publicly traded companies. Typically, when we're talking about the value of a publicly traded company, we're looking at earnings after tax. So certainly when you hear the price earning multiple is 10, they're referring to earnings after tax, and they're referring to earnings per share. When we're looking at private companies, because they tend to be privately held, they have a bit more opportunity to set up their tax situation and perhaps reduce taxes than public companies do. So we typically look at the pre-tax cash flow of the business, or what accountants refer to as EBITDA, or earnings before interest, taxes, depreciation, and amortization. So these are the types of things that we're going to look at. We look at the earnings before tax, we look at the interest expense, and we add that back. The reason we do that is we want to look at the business on a debt-free basis. So if the business had no debt, what would the cash flow be? Obviously, when you buy a business, you'll probably take on debt. But before you, as we try and determine the value, we need to add the interest back in order to look at the value on a totally debt-free basis. Depreciation amortization is added back in most cases because it's a non-cash expense. Also, to the extent a business is paying for some perks to the owner, say, a car allowance or maybe some life insurance or things like that, we make adjustments for those things. So we get to what we refer to as normalized EBITDA. What is the cash flow of this business once all those things are adjusted? When we're looking at smaller businesses that are typically owner-operated, there's another way of looking at cash flow that we refer to as discretionary earnings. And this, we take the EBITDA that we just calculated and we add back what the owner pays him or herself as a salary. So if the owner is taking out $100,000 a year, then we add that back and we refer to that level of earnings as discretionary earnings. And we'll address later sort of how we adjust for that in the multiple, because I know in speaking to business buyers over the past 20 years, they'll say, well, wait a minute, but I want to earn a salary and that should be deducted. And yes, you're absolutely right, except as we're trying to do our analysis on the value of the business, this is an extra useful data point to look at, because in some respects, it's a bit more independent than EBITDA, because EBITDA, we need to make certain assumptions on what is reasonable owner's compensation. Maybe he paid himself $200,000 a year, but maybe he could hire a manager for half that. So to sidestep that debate, we just say, okay, well, how much money does the owner have total discretion over, hence the name, at the end of the day, and then decide how he wants to receive compensation, whether it's T4 income, dividends, perks, etc. So let me start with a sample transaction. So here's a business. It's got revenue of $5 million, profit of 500. So that's a good 10% net margin. So that's pretty good. The seller is asking $4 million for the business, and the seller is willing to finance. So if we look at sort of our simplistic multiples, we've got a profit of 500,000. The price is $4 million, so that's a multiple of 8. So that's a bit on the high end based on what we've just talked about. However, the seller is willing to finance, so maybe this isn't a bad deal. So let's look at it from the seller's point of view. How did he come up with his price of $4 million? So looking at the 500,000 was a pre-tax profit. So that's what was reported on the statements as income before tax. Depreciation embedded in that number is 100. Interest is another 100. the owner had some perks where he paid certain expenses through the business that weren't absolutely essential to run the business. So all those things add up to $725,000. In addition, as I mentioned in my earlier example, he paid himself $200,000, and we've determined in discussions with the owner that he could probably hire a manager to run this business for $100,000. So really, his EBITDA, his normalized EBITDA, is $825,000. So, and that is after paying himself $100,000. So this is a pure EBITDA. This is what an owner would earn with a manager in place, so the owner does not have to work inside the business. So all of a sudden, the ask of $4 million, it's now only a multiple of 5 when we look at the true EBITDA. If we want to look at discretionary earnings, we're going to add back the other $100,000. So the owner himself has discretionary income of $925,000. So that is how much money he, at the end of the year, out of his business, he can decide, or the cash flow out of the business, that he can decide how to pay, either compensate himself, pay out bonuses, pay out dividends, etc. Also, in our discussion with the owner, he said, there's certain things that could make this business really grow, and so I think the profit could be an additional $75,000, which gives us a nice round $1 million potential profit for this business. So this is a seminar for buyers. This is what the seller said. So let's now look at it from the buyer's point of view. The first number, the 500,000, shouldn't be debatable. Hopefully, you can see the financial statements or the tax returns, and that number should be verifiable. Depreciation, obviously, that number would be verifiable on the statement, but from a buyer's point of view, what you need to look at is, well, what will your future capital expenditure be? Like, if you think about it, depreciation is a non-cash expense, but it does represent prior capital expenditure. So you need to take a look at that. Sure, we can add it back if we want to get to accounting EBITDA, but we may want to look or consider the fact that going forward, you may have to buy new equipment. And so what does that look like? Maybe it's not 100,000, but maybe it's 20,000. So that's a number that you need to make sure you understand. Interest should be straightforward. The perks, typically, there's not a lot of debate around that. You may quibble over, say, donations that might be, maybe the donations help drive your business, and maybe you don't want to cut them because of that. But certainly, it's not a hugely debatable number. The excess salary paid to owner, I mean, there may be a bit of debate on that number, but let's take that number as a given. So the EBITDA or EBIT, if we're quibbling over the depreciation, is sort of subject to the buyer's determination or research. The base owner salary, as we move on, that one is again, that would be show up in the T4, so that'd be provable there. And then the potential profit increase. Of course, a couple of issues here. First of all, as a buyer, do you believe that it's 75? Second of all, do you want to write a check to the seller for that? What we typically do in situations like this is if the seller can help make that additional profit come true, then perhaps there's some form of contingent compensation if the seller helps you to grow the business along those lines. So as we talked about, there's the income. With the income approach, income's a key issue. The other is the multiple. So in our previous example, we had EBITDA of 825. So how do we know that a multiple of 5 is a good multiple? So the things that drive the multiple are Interest rates, although interest rates have been low and stable for so long, interest rates are basically less of a factor than risk factors that are out there. So certainly industry risk, different industries have different multiples, and qualitative factors. And the qualitative factors are all over the map. So they are things that range from customers, employees, leases, the terms of sale. Certainly, say a cash transaction it would get a lower multiple than if the vendor is willing to finance. The owner time required. Does the owner need to be there 60-hour weeks, or is it a more manageable 40 hours a week? How quickly is the business growing, both in terms of revenue and in terms of profit? How volatile is that? So a business that is highly profitable but bounces up and down every year is going to get a lower multiple. The best way to think of the multiple is it's a reflection of risk. The more the risk of the business, the lower the multiple. The lower the risk, the higher the multiple. So this comes out in, if you look at multiples for real estate investments, they can be 10, 11, 12 times. If you look at multiples for businesses, we're looking at 3, 4, 5 times. So here's a chart on different multiples, multiple ranges. And as I indicated, the multiple is different depending on the level of income you're looking at. So as I mentioned, discretionary earnings is the highest definition of earnings in that it's EBITDA plus one owner's salary and benefits. So it'll be higher than EBITDA will be. So the multiple is correspondingly lower. So for if we have a discretionary earnings of 300,000, the multiple is going to be, say, 2 to 3 times. So that would be applicable in a discretionary earnings scenario. For EBIT or EBITDA, and EBIT is really just EBITDA, except we don't add back the depreciation because, as I mentioned earlier, your capital expenditure, if your capital expenditure is more or less equal to your annual depreciation, you might as well just look at EBIT and not add back depreciation at all. Situations like that, we're broadly speaking looking at 3 to 5 times multiples of EBIT or EBITDA. For some businesses that are well set up and well structured, it could go as high as 6 or 7. You know, I've seen higher multiples than even those, but those are in rare cases. Perhaps the business is having a bad year, but the buyer knows that they can double or triple the income quickly, so they might offer a multiple that seems higher, but really is it reflects the fact that the track record is there, that the business can do the higher income. Another way of looking at value is the business needs to be able to pay for itself. So a business should be able to afford a salary to the owner if the owner needs to work there full time. It should be able to pay off acquisition debt, both principal and interest, assuming the original transaction was structured appropriately. If you try and buy a business with $1 down, you may have trouble paying off your acquisition debt that's 99% of the overall value of the business. It should be able to pay for new capital investments as required, and you should be able to finance some growth in the business as the business grows. So just a summary of what we do. We help people obviously with business valuations, whether you're looking to buy a business or sell a business or transition a business to your family. Any scenario where you need a business valuations, we help with formal written business valuations. We help people buy businesses. We do business brokers, so we help people sell businesses and mergers and acquisition. We assist with family transitions, primarily in the valuation and structuring side, and we assist with management transitions in that scenario. We can also help with a business plan. We've done them for startups. We do them typically for financing purposes. We also assist with strategic planning. So thank you for listening to segment 3. We're going to move on to part 4 of this scenario, where we get into financing and deal structuring. In the meantime, if you have any questions, feel free to email me and take a look at our website to learn more about what we do. And we have a blog there and other articles and webinars.